Hello, everyone, and welcome to Smartkarma's corporate webinars. I'm Vidhi from the corporate solutions team at Smartkarma. This week, we are very glad to have with us Del Monte Pacific's Chief Corporate Officer, Ignacio Sison, also known as Iggy.
Good afternoon, everyone.
And we also have their IR manager, Jennifer Louis.
Hi, everyone.
We will start this webinar with Jennifer and Iggy walking us through a company presentation, after which they will engage in a fireside chat with Smartkarma Insight Provider, Nick Van Broekhoven.
Hi, good afternoon.
We will be taking Q&A from the audience. So I would like to request our attendees to post their questions in the Q&A tab at the bottom of your screen. During the webinar, I will share links on how you can connect with Del Monte Pacific and also how you can read research by Nick. So please keep a lookout for messages in your chat box. With this, I will hand it over to Iggy and Jennifer to walk us through a short company presentation. Over to you, Jennifer.
Thanks, Vidhi. Good afternoon, everyone. Thank you for spending an hour of your day to hear more about our company, Del Monte Pacific. We are very proud of our long heritage of 136 years. We have exclusive rights to the premium brands Del Monte and S&W in certain markets and products. We own the Del Monte brand for processed or packaged products for US, South America, Philippines, the Indian subcontinent, and Myanmar. There are other Del Monte companies in the world, and these companies are unrelated to us, so they own the brand in other markets. So Fresh Del Monte owns the global rights for Fresh, Del Monte Fresh. So if you see the Del Monte bananas here in the grocery, that's not from my company, that's from that other company. They are New York listed. We use the S&W brand for fresh pineapple, which you can see in NTUC here in Singapore. We're listed in Singapore and the Philippines. And who owns Del Monte Pacific? We're majority owned by Nutri Asia Pacific of the Campos family. And who is the Campos family? The late father of our CEO started a pharmaceutical business in the Philippines, and that's now become the largest pharma business in the Philippines, much bigger than any of the MNCs there. And his sister is the one managing that business. Our CEO has food interests. Del Monte is his only public company. His other food interest, Nutri Asia, is the largest condiments company in the Philippines. He is also into property, and he is the chairman of Fort Bonifacio Development Corporation. Del Monte Pacific operates 6 factories in the States, 2 in Mexico, 3 in the Philippines, and 1 in India. We have leading positions for packaged products in the US and the Philippines. And we're very proud to share that we have won a number of awards from the Singapore Corporate Awards, such as Best Managed Board, Best CFO, and I'm happy to share that Iggy Sison was our CFO then who got this Best CFO award. The 2 tables below are our market shares and market position in the States and in the Philippines. So in US, we have number 1 to number 3 position, whereas in the Philippines, we're number 1 in these categories that you see here. In terms of product split, based on 9 months results ending January 2022, in terms of geography, US accounted for about 70% of our sales, followed by the Philippines at 17%, Asia ex-Phils at 11%, and Europe at 1%. In terms of product split, packaged fruit and vegetable is at 64%. Culinary, or what we call cooking aids like sauces, ketchups, pasta, basically tomato-based products, these are 19% of our business. Fresh fruit and others at 9%, and beverage at 8%. We have 2 major subsidiaries. So that's Del Monte Foods in the States, where we own 93.6%, and Del Monte Philippines, where we own 87%. So in the States, as I mentioned, it's one of the leading F&B companies there. And in the Philippines, we've been there for 96 years, and we are the #1 exporter of fresh pineapple to China, and top 3 in Japan, South Korea, and the Middle East. These pie charts are shared to group sales, EBITDA, and profit. So Del Monte Foods had a 70% share of sales for 9 months. For EBITDA, it's 56%, and for net profit, it's 32%. So I'd like to highlight that Del Monte Foods has turned around. So starting last year, it turned into net profit. Prior to that, it was incurring losses. So from 15% share of net profit last year, it's now gone to 32%, and it's increasing. So we grow 2 types of pineapple, C74, which is mostly processed, what we put in the cans. And we have an MD2 variety, which is mostly sold as fresh. Out of our total area of 26,000 hectares, about 7,300 hectares is planted to MD2. And we are one of only 3 industrial scale MD2 producers in Asia. We are strategically located, so the location is quite ideal. We are in Bukidnon, Philippines. That's in southern Philippines. So you have to fly to Manila, and then you have to take another 1.5-hour flight to the south, and then a 2-hour land trip to get to the plantation. So it's in the same latitude as Hawaii. So Hawaii is where it all started. So we're located in the same latitude. It's on a volcanic soil, on an optimal elevation, very cool weather. So this is the ideal growing condition for this MD2 variety. So it's a high barrier to entry. What makes this MD2 pineapple special versus other varieties? First, the taste profile is different. It's much sweeter. It's not as acidic as the pineapples that we've grown up with. You know, like when you used to eat pineapples, you can't eat a lot of it because it bites the tongue. This one doesn't bite the tongue. And it has longer shelf life, and it's a sought-after variety in North Asia. So as you see in the bar chart on the lower right, we've grown this business to about $115 million business with a sales CAGR of 17% in the last 2 years. And we're continuing to grow this by expanding into the tier 2 and 3 cities in China and expanding the e-commerce business as well. So we are the #1 in South Korea's e-commerce portal. Our S&W Fresh Pineapple is #1 there. And we've also launched a new SKU, which is sweeter than the current SKU. We call it S&W Deluxe Premium. So we've launched this in North Asia. Okay, let me now turn you over to Iggy, who will discuss the rest of the slides.
Thank you, Jenny. Moving on, so Del Monte Foods, or DMFI in the US, as Jenny said, accounts for about 70% of total sales of Del Monte Pacific Group. I want to highlight in this chart, as you will see, the sales increased by 8% in the 9 months ending January at $1.2 billion. That's the bar chart in the first row. If you look at the middle row, you will see the EBITDA at $155.8 million. That is higher by 20% over the same period in the prior year. And the EBITDA margin is 12.5%. And if you compare the 155.8 and you annualize that to 12 months, you will get an EBITDA which is much higher than the 170.5 million that you see on the left side, which was the 12 months EBITDA in the prior year. So very good growth at 20%. And at the bottom row, you will see the net income of $35.2 million. That is more than 3 times the 10.5 million in the 9 months of the prior year. So that's a very strong growth in profit. And if you look at the full year of the previous year, it's only $15.1 million. In 2017, we appointed a new CEO, Gregory Longstreet. If you want to listen to him, you may do so through our Del Monte Pacific website in our latest results. And since he joined the company in 2017 as a CEO, he's appointed a new Chief Marketing Officer, as well as a Chief Customer Officer and Chief Supply Officer. So we have a very strong leadership team. Another thing that we did, which is very important, is closing 7 factories from FY16 to FY20, following our asset-light model to reduce fixed overhead. And this has helped improve the margins of Del Monte Foods in the US. It also allowed us to accelerate branded sales, improve profitability, and with the reduction of the number of plants, we also reduced significantly sales to private label, which are low margin. And the final bullet you'll see here is the robust product innovation pipeline that we have, as well as the improvement of our sales in different channels. If we can go to the next slide, this highlights the innovation that we have in the US market. From the left, you will see some of our products are positioned as close to fresh, like this vacuum-packed vegetable product, or plant-based products like this rice vegetable. We also have culinary or cooking convenience products such as tomato products and broth in the US. We're also into snacking for on-the-go offerings, which supports remote working, for example, or distance learning. And finally, we have this everyday value, which is very important in this inflationary environment because our multi-packs, as you will see on the right-hand side, are doing very well because of the value that's offered to the consumer. And this has resulted in the transformation of the company from being a canned food company to a food innovator. And I'm pleased to highlight that in the last 4 years, Del Monte Foods has won Product of the Year awards 4 years in a row, including the latest year. On slide 7, this summarizes our 9-month results ending January for Del Monte Pacific. So $1.7 billion of sales, higher by 6.5% on higher sales in the US market, S&W fresh, and packaged products. Our gross profit was higher by 12.4%, and that was also aided by a favorable sales mix in the US, mainly through higher sales of branded products, particularly vegetable products. We also did a number of price increases since the start of the fiscal year in May last year. And we also benefited from lower pack costs from the prior year. You will see EBITDA at $273 million, higher by almost 16%, and net profit at $80.1 million, higher by 64% than last year. Net debt is at $1.4 billion, while it is higher due to working capital because we have to support higher inventory to support higher sales level. Our gearing is lower at 2.1 times equity, or as we prefer to look at it, at 4.2 times net debt to EBITDA multiple. Moving on to slide 8. So this is our last slide. It's an excellent summary of Del Monte Pacific's investment merits as a company. And these figures are based on the 9 months results that I just highlighted for the period ending January. 6% sales growth, 16% EBITDA growth, 64% net profit growth, net margin improvement by 160 basis points. New products, as a result of that innovation we shared earlier, now account for 5 to 6% of total sales in the US. And we have leading market shares, leader in vegetable, leader in fruit, in tomato, we're number 3. So if you look at the left-hand side, these figures support the investment merits on the left-hand side. I'll just go through it very quickly from the top of the circle. Strong market position, iconic brand that consumers love, highly effective management team with proven results, as you will see in the strong results that we have. good earnings profile with upside driven by innovation and expanded distribution, a solid business with strong free cash flow, and finally, recent performance, which is robust and very positive, reflecting the successful execution of the strategy. So this provides an overview of the Monte Pacific. Thank you.
Thank you, Iggy. Thank you, Jennifer, for the presentation. I think now we'll go into the Q&A. There's some questions coming in on the chat, but I'll start with a few background notes maybe. So Jennifer actually reminded me that I've been following the company since 2013 when I was on the buy side still. Afterwards, there's been a lot of developments and the company went into the US, which at a certain point did not turn out so well because the debt load was quite high. And then last year, I wrote a piece on Smartkarma highlighting the opportunity for the company to IPO either its Philippine assets or the US assets or both, which had been discussed publicly in the media. The stock at the time 1 year ago was about 23 cents. And then it almost doubled, I think, to over 40 cents. I'm talking about Singapore dollar share price. And now, after the latest results and with everything's going on in the world today, it's come off a bit. So it's a good opportunity to speak. And now that your results are out, you are able to address those freely. So I think we will go into that a little later. I think I wanted to start off by last year. What was really the catalyst for the re-rating was the potential of listing the Philippine unit. So that's the DMPI unit for those who've been following the presentation. And you tried to list. In the end, the deal did not go through to many investors. That was disappointing, especially as it already happened in 2018 as well. You tried to list at that time as well. So can you please provide some background? What was the main reasoning that the deal after 2018, now also last year, was not able to meet the finish point?
Well, to begin with, Nick, thanks for that question. We still plan to list Del Monte Philippines someday when the market conditions are optimal. Last year, we tried to list Del Monte Philippines, but you will also have read about the largest listing on the Philippine Stock Exchange by another food company. And that was right before ours and turned out to be the largest offering ever. And of course, that had an impact on the liquidity of the market. And that's something beyond our control. But what we have focused on is the continued profitability of Del Monte Philippines. So yes, we did not list it last year, but now in the 9 months for this year, the net income of Del Monte Philippines is up 15% at $81.5 million. So when we bring it back to the market, it will be on a higher net profit base. And we believe with the expansion of our fresh pineapple business in markets like China, where we are market leader, and we are number 2 or 3 in Japan and South Korea, with the growth of our fresh business, which is now over $120 million business, that should also improve the margins of the company. So higher net income, better margins, so hopefully better valuation. But it's really dependent on the market conditions.
Yes, and obviously that has changed now. If you look at the recent share price action, not just in Del Monte, but overall in Asia, and especially Hong Kong, etc., has been quite negative with all geopolitical issues that are going around. I will actually weave in a first question that's coming here from one of the participants, which is, what is the current situation in Russia and Ukraine? Does the company do any business there, and will it affect Del Monte adversely? Any quick answer to that?
We don't have any sales in Russia or Ukraine. We don't own any assets in those two countries. The impact on us will be mainly through commodity inflation, especially the price of oil. But there's no direct impact in terms of assets or revenue. And we just have to manage the cost increase through various measures.
And what is that? What is that exactly? Because this is a global issue. This is not just Del Monte. I mean, you're seeing cost pressures everywhere, rising fuel prices, gas prices, all input costs are rising. You are expecting this actually food inflation to get even more, depending on which category. But if you talk about wheat prices, etc., with Ukraine being a significant producer, that these things will go up. Palm oil prices have also continued to skyrocket, which is in a variety of products. So can you maybe, when you talk about inflationary costs, how are you passing them on? Are you doing standard price increases of X% in specific markets? Are you reducing package sizes? Maybe some examples that would be useful to investors.
Okay, we've been implementing several measures. In fact, even before this Russia-Ukraine conflict, we've been working on bringing down our costs. As I said earlier, we've closed down 7 factories. And that cost management, cost initiatives has been in place and continues to progress. On the supply chain, we have a range of cost initiatives. So cost management is very important. Second, we've also improved our sales mix significantly. Of course, the more branded sales that we are able to realize, and the less private label sales. And private label today is only 5 to 6% of our sales. It used to be as high as 15+%. And so favorable sales mix means much higher margins for us, and you will see that in our 9 months results. Third is we have been taking pricing since the start of the fiscal year in May. We've had different rounds depending on the category, some in May, some in September, some in January, some even this month of March and April. So we have been taking pricing wherever we can. And that is also a reflection of the brand equity of Del Monte. Our pricing power, our brand equity allows us to make those price adjustments and to be accepted by the consumer. And you will see as well as despite these rounds of prices that we have taken, our market shares continue to be very healthy and very strong. In fact, for example, for canned vegetable in the US, it's higher by 4 percentage points, and it's a record high. You also mentioned the packing size, Nick, right? One type of product which is very popular now in our markets is the multi-pack size. So it's like bundling products together. Consumers like that because they're able to buy many products at today's price instead of at a higher price 3 months later, right? And of course, since it's a bundle pack, it's a multi-pack, it offers value to the consumer. So just to give you an example. So combination of pricing, better sales mix, cost management, offering value also through these multi-packs. One other thing we've done in the past few years is we have been rationalizing trade promotion in the US. Historically, the trade promotion was over 20% of gross sales. Today, it's down to 15%. And that 5 percentage point reduction or 500 basis point reduction gives us a lot of room to manage our margins as well. So it's a combination of all of those.
And if you look at go ahead.
If I may add on the cost management, some specific examples include using more rail in the States instead of trucks. So then you become more efficient and it lessens your fuel costs and labor costs. As you know, the labor for truck drivers, the wages are also increasing. So we've been utilizing more rail or train in the US.
Okay.
Another one would be down gauging or lessening the use of thin plate in making cans. So you've got thinner cans, so you have less thin plate to use. So those are some of the specific examples of cost reduction.
Okay. And I have a question, I mean, because you talk about price increases, there's also the role, because you don't sell everything direct from your warehouse to the consumer. There is a supermarket or a convenience store in between. In Europe and in the US, there's now rife with stories about, a lot of pushing and fighting between the CPMG companies and the supermarkets, because they are basically, some of them have longer term agreements where you cannot implement price increases in the meantime. But now, because of the rapidly rising costs, a lot of the producers want to increase the prices to the consumers. So how is this, with your relationship with yes, you have a strong brand, you have a certain amount of shelf space with big customers in the US and in the Philippines, etc. Is this an issue for you, that the supermarkets, and in the end, who are the touch point with the final consumer, are making it difficult for you to pass on those increases, or is that not an issue for you?
It's not an issue for us. We have very strong relationship with our trade customers. One excellent example would be Walmart, which accounts for 1/4 of our sales in the US. Very long-term, very positive relationship with them. And as you alluded to, the industry is increasing price, not just in the food sector, but other sectors, industries as well. Groceries are also adjusting price. So in this environment, there's no issue for us to adjust prices.
Okay.
It's really par for the course, and it's really expected of us. Yeah.
Okay. Then you mentioned a bit on the slide, but I would like to have some more maybe examples about you being a food innovator, because that, of course, is better for margins. So that's also makes you, I think, from an investor point of view, a more interesting company than just basically cutting pineapples and putting them in a can and selling them onwards. If you're making food innovation, if you're increasing awareness of the brand, but can you give some specific examples, which have been some of the successes you've had, maybe in the US market or in the Philippine markets on that front? That would be helpful.
Yeah, for vegetables, Jen, feel free to share that slide. For vegetables, we have introduced rice vegetable, as they call it, or it's rice made of cauliflower, for example, and also vegetable pies, right? So this are outside of the can. You will see there in the second column from the left. Another product that's been very popular, second from the right, is the Joyba bubble fruit tea. Okay. And this is very popular among millennials, the younger demographic. And we've always been considered as a vegetable and fruit company. So this kind of innovation really expands our product portfolio. And we also have fruit in plastic cups for on-the-go offering. And as I said earlier, we've had products that have won Product of the Year award 4 years in a row for different products. And this would include products like Joyba and the vegetable products here. So innovation is very important for us. This year, it's 5 to 6% of sales. Next year, we target to raise that to about 8% or so of sales. Today, it's around 85-90 million US dollars. Next year, it will be over 110-115 million US dollars. So innovation definitely is very important. And innovation, not just for the sake of innovation, but of course, we always have added value to the consumer. We always provide something better, something good for you. Yeah, which is the Del Monte brand equity.
Yeah, and then during the whole pandemic phase, which obviously is not, at least not over in China as we see now, and again lockdowns appearing, but here it's saying in the West, in Europe, and in America, life is coming more or less back to some sense of normality at the moment. And there was a trend for cooking from home. People were not going outside, so that was benefiting your canned food sales. Is this now hurting you, that maybe, especially in your US-centric business, that this is returning back to normal? And are you seeing this? Are people, cutting back on their canned food sales because they're going out maybe more to restaurants, etc., going more outside the home, or are you finding ways to mitigate this change?
Well, as you will see, our sales for the third quarter from November to January in the US were up by 6%. And that's our most recent quarter. And that is more volume driven. Most of that is volume, some pricing, but 6%. So I think that's very strong evidence of people continuing to buy our, canned vegetable, canned fruit. And we think, that's really the new normal, even though the economy is reopening. We believe people will continue to value health, wellness, and nutrition. I think the awareness of health and nutrition was a lot more heightened during the pandemic, right? More consciousness of health. And you will ask, why did we sell more products during the pandemic while private label was actually selling less? And private label is cheaper, right? But there was a flight to quality, a flight to better for you products. And since people could not go out, they wanted something better for them. And our sales continue to show that it's growing by 6% in the last quarter, growing by 8% in the last 9 months. At the same time, as the economy reopens, our food service is now recovering. So we benefit also through food service. Our food service is actually our fastest growing category now because of the recovery during the pandemic, whether it's in the US or in other markets like the Philippines. Although it's only $100 million of sales in the US, we are very optimistic that our food service will continue to grow. So the key is to address consumer needs, whether they are at home or whether they are consuming in one of our food service outlets like hotel, restaurants, or schools. We also have products for schools, for students. So it's really to capture the consumption occasion in different locations and different occasions during the day.
Okay, and if we move away from the U.S. market and look at China, obviously it's a huge market. I mean, right now the Philippines is way more important than China as your current contribution. But can you maybe talk about your positioning in China? What are some of the important products that you have for consumers there? Is there an opportunity for you to grow in China or North Asia as a whole? Maybe any comments you can give on that front?
Yes, our most important product in China and North Asia, including Japan and South Korea, is the fresh pineapple that Jennifer talked about earlier, the MD2. And you can also see it in the background that's behind us. This MD2 is a superior variety of pineapple. Just think of, if you think of high value rice, you think of jasmine rice in Thailand, right? And this is probably a good analogy for pineapple. This is the best pineapple in the market. It's as good as the one that's produced in Costa Rica, which produced the gold standard for fresh pineapple. In fact, we have Costa Ricans also in our plantation operations. And now we have 53% market share in China. It's the #1 imported pineapple in China. We have overtaken Dole. We have overtaken other brands. And we are very well positioned in the first tier cities like Beijing and Shanghai. Our expansion now is to second tier and third tier cities like Chengdu and Guangdong and others. So the key really is to be the best in quality. That's really the reason for the successful sales of the product, because it's of a higher quality, which is different from what is grown, for example, in Hainan Island in China. And second is to improve distribution. We have partnered with Good Farmer. Good Farmer is the leading distributor of banana in China. So because of their fresh distribution for banana, we have co-branded with them for pineapple. And that has resulted in phenomenal expansion for us, that partnership. And we're also in e-commerce, and now we're expanding into tier 2 and tier 3 with other distributors. The per capita consumption of pineapple in China is very low compared with Japan and South Korea, for example. So in fact, our ability to supply is still outstripped by demand. Demand continues to be much higher. And so it's a good problem to have. We continue to grow this MD2 pineapple, and please try it in Singapore at NTC Fair Price, and you'll see what we mean, because it's really the best pineapple there is.
Okay. Now I'll think, because we have about 10, 15 minutes left, there's quite a few questions on the chat. So I will just try to work my way through them and see, what your response is. So one of the questions is from Daryl Lim. He's asking, hi, can management please share what is the projected stabilized gross margins? Seems like margins are jumping around each time results are announced.
Our margins have actually been improving since last year. Del Monte Foods in the US, which accounts for 70% of Del Monte Pacific sales, has had 6 successive quarters of growth, of profitability, and margin improvement. And as I said earlier, with the combination of our cost initiatives as well as our price adjustments, we continue to maintain our margins. If you see the, can you share the 9 months results, Jen, just to emphasize the point?
Okay.
Yeah, you will see improvements in margin for the 9 months from gross margin to net margin. Yes. So the gross margin we have is about 27%. This is the sustainable level that of over 25% for gross margin. And in the US, which is 70% of the business, gross margins around 24%. In the Philippines, it's around 30%, but the weighted average is around 27%. And we believe we'll be able to sustain that through better mix. And better mix is best supported by 2 types of sales. One is the more branded sales we generate in the US, the better for us. Canned vegetable, branded canned vegetable margins in the US, for example, are over 30% for gross margin. The fresh that I discussed a while ago, the fresh pineapple, our gross margin is over 40% for fresh. So the more fresh pineapples we sell in China, the better it is for overall margins. So that's really the long-term sustainable level for the gross margin, around 27%. Yes, of course, we try to aspire for more, to target more.
If I may
Another
add,
question. Oh, sorry, go ahead.
Daryl's question alluding to margins jumping around. He might be referring to the third quarter results where there was a dip in margin. Our price, we had price increases in March, and there's some more in April. So these are not yet factored into the 3Q results. So 3Q, there's a dip. There was hardly any price increase there. But going into 4Q, we should be able to improve versus the 3Q margins.
Okay.
Yes, and if I could add just on the 3Q, of the 4 quarters we have, 3Q, while it's a high sales quarter, in terms of margin, it's not the highest because of a lot of trade promotion in the US around Thanksgiving. But that's seasonality. But the fourth quarter, second quarter tend to have the highest margins for the US as well as the Monte Pacific because of seasonality.
Okay, then I have another question from an anonymous attendee, but I will ask it. It's what is the breakdown of cost of goods sold for the US and for the Philippine business? And then he says, how much inflation are we seeing in each of the units, being fruits, vegetables / metals, packaging, transportation, labor? I mean, maybe any kind of color, what kind of inflation in the cost of goods, that would be helpful.
Yeah, packaging is about 25 to 30% of our cost of goods. And then the raw produce, whether it's the raw vegetable or the fruit, would account for about 30 to 40% of the cost. And while there are cost headwinds, for example, for metal packaging, what we are doing is lightweighting or downgauging, for example. Let me read some of the measures that we are working on. We have a long list, whether it's high rail utilization, which Jennifer mentioned earlier, lower waste, higher productivity across our production facilities, higher recovery of product. We've also negotiated our long-term tin plate prices with our biggest producers. And we've also been rationalizing our distribution center. So we have been working on several supply chain or manufacturing related initiatives to offset the higher increase in metal as well as in freight. But what we also have to do is to adjust prices. Unfortunately, the cost initiatives cannot offset the cost headwinds, right? The tailwinds are not enough. That's why we have to also adjust prices.
And if you look at your product portfolio, is there any, is this another question here from one of the attendants, does the company produce GMO food products? If no, why not? And if does it intend to do so in the future?
We actually, GMO is an interesting question, because if you talk with a scientist, if you talk with any scientist, GMO is actually good from a scientific point of view. Unfortunately, the GMO, non-GMO is more of a consumer perception in the marketplace. But GMO by itself has actually improved food supply around the world. It has actually generated more supply, especially in continents like Africa, for example. Nothing wrong with it. But in the US, unfortunately, there's more preference for non-GMO, which is why our products are labeled as non-GMO, whether it's for corn and others. It's really more consumer driven and not science-based. Yeah.
Okay. Then a question about another attendee question about supply chains. I mean, obviously, especially with China, you're shipping in fresh product. How are supply chain delays, transportation costs affecting your fresh food, and how do you manage this? Is this a major concern for you going forward?
The shipment of our fresh pineapple from southern Philippines to China just takes about a week or so. So it's a very short shipment time. And we have a window of 3 to 4 weeks to sell the fruit. So not an issue for us. Unlike shipping to the US, that's a much longer shipping time. But from the Philippines to China, Korea, Japan doesn't take much time. And it's not an issue for us. Yeah.
Okay, then I'll ask, and there's another question here from Daryl Lim. What is management's ideal capital structure? Any updates on fundraising, either debt or equity, for the coming year?
Yes, I'm glad Daryl asked that, because we were not able to stress earlier that what we are working on now is bringing down the cost of our debt. In the US, for example, we have a $500 million bond, which is it's a 5-year bond which matures in 2025, but it is callable in the middle of May. So our intent is to call and redeem that earlier, 3 years ahead of maturity, because the rate is quite high at 11.875%. And based on the syndicated loan, which we plan to have in place by middle of May, we expect the rates to be less than half of that, 11.875%, which will result in significant savings. Although there are redemption costs, there are one-time redemption costs, as well as one-time deferred financing costs, which will have to be written off. So, and that will be reported in our first quarter. And I think since we've already announced it in our full year results, the one-time cost will be $70 million. However, there will be savings every year of $25 to $30 million. It's a 7-year loan, and we will be able to recover the cost on a cash basis in 18 months. So we believe it's the right move to bring down the cost to less than half of the interest rate now. So that's for the bond in the US. For Del Monte Pacific, we have preference shares which are perpetual. We have no maturity, but again, we have the option to redeem this April, and our plan is to redeem $200 million. The preference shares have a coupon rate of 6.675%, and we believe we will be able to refinance that at 3.5% to 4%. So if you look at the savings of 3.5% to 4% versus 6.75 on $200 million US, that will result in savings of $4 to $5 million US a year. And in December next year, we intend to redeem another $100 million, and that's at 6.5% coupon. And if we are able to refinance that at 4%, so that would be another savings of 2.5. So that will be like $7 million US savings for the 300 million preference shares. And in the US, it will be $25 to $30 million savings. Eventually, it is the IPO of the Philippine company as well as the US company. Those two offerings, whichever happens first, will of course help improve the capital structure of the group, because that will allow us to raise equity and retire more debt. But in the meantime, we are bringing down the interest expense quite significantly in the group.
Yeah. What was the charge you set for the early bond redemption in the US? What would you have to pay for that?
The total is it's $45 million for the redemption cost, and there's another $25 million of deferred financing charges, which were incurred in the bond issuance, which we have to write off. But the savings of the interest will be $30 million a year.
Okay.
So that should be recovered within the tenor of a 7-year loan. Yeah.
Okay. All right.
Yeah.
Understand.
If I may add, just to manage expectations also, because we are replacing preferred equity, that's $300 million with loan. So the gearing will go up. In the interim, the gearing will go up. So in the slide that we presented, we showed a 2 times net DER, net debt equity. Once we do all this refinancing, the prefs will be treated as a debt. It will go up to around 4 times. So just to manage expectations. But what's important to highlight is that I guess it depends how you see it. It's just a change from equity to debt. But in terms of cash flow, instead of paying 6.5 to 6.6% on the preference shares, now the cash cost, the interest expense will come down. So it's anywhere but maybe 4 to 5%.
Okay.
Yeah. So save 7. We'd rather save that $7 million a year. Yeah, per year.
Yeah. Understand. I think we've come. I will finish here with some last question, which is important to always SGX focused investors, is the dividend. And how with the fact that you're both reducing debt and you're in the process of on the US business with this, probably by May, how should investors think about paying, the company paying dividends going forward?
Our dividend policy is to pay at least 33% of the prior year earnings. So that continues to be in place. And if you'll see our dividend payment history, we've been paying at a minimum 33%. So we will continue to do so.
Okay.
Yeah.
All right.
And as our net income improves and increases, and of course, that dividend per share continues to increase as well.
Okay. Yeah, Vidi, I think for me that concludes the talk. We're in 50 minutes into our chat, so maybe you can round it off.
Sure. Thank you so much, Nick. They were very interesting questions and very nicely positioned in terms of finding out more about Del Monte Pacific. I want to say a big thank you to Iggy and Jennifer for joining us today and giving us an insight into the company, into the sector, what are the challenges, the goals, what are the next steps, etc. And I also want to thank our attendees who could join us today live and shared some really interesting questions as well. So thank you everyone for your time today, and we will see you again next week.
Thank you.
Thank you, Nick and
Thank
Vicky
you.
and Smartkarma,
Thanks.
and to all the participants who joined us this afternoon. Thank you very much.
Thank you.
Thank you. Bye-bye.
Bye.
Bye-bye.